welcome everybody on this interesting topic that we wrote on is, adapt or get disrupted. So essentially, I think so this thing is very, very clear in the ever-changing dynamic, world of technology. We are seeing that businesses and cycles are getting shorter. More importantly than cycles, if you think about, there are several businesses that are going through evolution phase, and in some cases, disruptions are hitting them right, left, and center. As a company or investors or larger business promoters, one needs to adapt to obviously not only compete but also be stay ahead in the disruption era. I will just share with you a few examples that we see happening around, and also how the businesses and the companies are preparing and adapting to these changes. First and foremost, I think so this is fairly widely anticipated disruption of EV e-scooter compared to ICE. ICE is internal combustion engine. If you go back to a decade, I think so broadly the market perspective was that, hey, I think in few years EV is going to overtake ICE. However, the percentage will obviously depend on various factors, affordability, total cost of ownership, and so on and so forth. When you look at the total cost of ownership, I think so the biggest impact for a EV business has been the battery prices. And if you look at the last 5, 7, 10 years, battery prices have collapsed by as high as 80%. That also leads to better cost of ownership, but more importantly, the newer and newer technologies in the two-wheeler space as well as the small cars are making that the business is certainly getting transformed into EV vehicles. So this is obviously an ever evolving era. To our mind, and a lot of businesses will get completely disrupted if they are not A, prepared for the future, and B, they are not even obviously coming with industry leading technologies with respect to the total experience of the bikes as and the cars for the consumers. When we move to the next particular industry, this is again a very interesting industry which has obviously began. If you go back to the roots of the industry, that industry started as dated as two decades ago, but lately because of the significant amount of innovation and increased competition both from India and China, the diamond industry is seeing a significant disruption. When I say the disruption, because I'll give you two important data points. The last 25 years, the earth mined diamond or the so-called natural diamonds that we know of have remained stagnant in terms of pricing realization per carat. However, if you look at the lab-grown diamond, which is nothing but having the same characteristics of a diamond, but obviously manufactured in a laboratory, the prices actually come down by nearly 80% in the last 5 years. Obviously the reason of that pricing collapse is a function of significant improvement in the demand and also new technologies coming in India as well as China from an overall capacity supply point of view. So we think this industry, will see us not only will lab-grown diamond as an industry will see a significant room going forward. To our mind, the volumes will probably go between 2 to 3 times in the next 3 years, 3 to 4 years, and the volumes have already doubled in the last 5 years if you look at the numbers. Moving to the next industry, which is again a very rapidly growing industry, is the evolution of the retail and the quick commerce. If you just go back to the decade or so, the broader consensus was GT will get disrupted by modern trade. Then you had a question on, modern trade will get disrupted by e-commerce. And now obviously we have a new phenomenon in the last 2 3 years that e-commerce will get disrupted by q-commerce. So quick commerce is nothing but the convenience and the massive amount of behavior change that companies are giving the consumers to change to. Not only are they not only are they expecting a faster delivery timelines, but also the kind of repeat purchases as well as the frequency of purchases are witnessing a completely different change, because not only it impacts the supply chain dynamics but also changes the unit economics of the behavior for a consumer. So we think quick commerce is again another very very important example of disruption which is witnessing in the industry. And in our belief, this will become multifold in the next 3 to 5 years time frame. Moving to next, if you look at the quick commerce industry, were actually virtually absent, in 2021, post COVID, when it started with Zepto. If most people remember, now it's obviously as high as $3 billion market. To our mind, this market can actually grow 10x in the next by the end of this decade. And obviously, three largest players are Zepto, Blinkit, Swiggy, which essentially are not only driving the business but also significantly enhancing the experience and the consumer in the top 500 cities in the country. So what are the three important instances that we showcase, teaches you? In most of the industry, the in some cases the pace of transition is very rapid, which is like quick commerce. If you are not obviously adapting your business model to those, you will get disrupted. Second, EV as an industry has been there in terms of disruption, but obviously it picked up lately pace significantly because of the cost of technology becoming more affordable. And third, most important, is the driver of the next, in the next 3 5 years will be the diamond of lab grown compared to earth mine diamond, which will see a massive disruption in the industry, both for the consumers as well as the key players. Moving to the instances that we have shared, as I was saying, that IGI is one of the best companies who have significantly seen a benefit of the lab-grown diamond opportunity, because IGI is a company which basically certifies the lab-grown diamond, earth mine diamond, as well as gems and jewelry of all sorts of kind. But the point I'm just trying to allude you here is they are a global leader in terms of market share, 65% as we speak in lab grown diamond.
Yeah, so I can take it forward till the time Trilok comes back. So what happens with IGI is that, as Trilok highlighted, that IGI is one of the best plays lab-grown diamond story in India. And the reason for that is the clear market share gains which is happening. So if you look at CY20, the market share of IGI was just about 10.7%. But if you look at CY23, the market share has gone up to about 31.3%. And every year, they have been consistently gaining market share. If you look at CY20, CY21, CY22, CY23, and the largest player, GI, has been consistently losing market share. And the main reason for IGI to sort of consistently gain market share has been the advantages of the person who is giving the certificate. So they now have their own institute where they are training people who are sort of giving the certification. And that's where they are able to add onto that number on a consistent basis. They've also increased their range in terms of products where they are getting certified. So clearly, we see that not only the company will get benefited out of the rising penetration of a lab-grown diamond, but within that space, they'll continue to gain market share. And as you can see, it's a sort of a duopoly where the top two players have effectively the entire market share to themselves. So to that extent, what happens is that there will be enough pricing power as well in this industry. Unfortunately, what has happened is that the lab-grown diamond prices have been falling. Now, obviously, they are at a level where they are settling down, and the certification pricing has to be linked to the lab-grown diamond pricing. That's the reason why you've seen recently some pressure in terms of pricing for IGI, but now that the prices of lab-grown diamond have settled down in IGI, also we've seen pricing settling down since the last 6 to 8 months. And if you look at their capital efficiency for IGI, it's not a capital intensive business. So the company continues to do ROICs north of 85%. which means that they can easily grow the business from here on without any requirement of capital. So that's what is the most exciting part of the business, that it's in a sector which is growing very rapidly. Plus, they are gaining market share. And the third bit is to grow the business, they don't require any capital. Yeah, Trilok.
No, thanks, Bhargav. So essentially, as Bhargav highlighted, that this we are very, very enthused about the opportunity and the disruption. IGI will essentially benefit because of the participation in the lab-grown diamond certification. Similarly, Zomato, obviously, we very well are aware of. Blinkit has been the key pioneers in participating for the quick commerce opportunity. Not only have they created and a very strong brand after they acquired Grofers and renamed as a Blinkit in 2023, but they have also been a significantly driver in terms of unit economics from a incremental store point of view as well as cash flow for the business is remains very healthy. Subsequently, when you move to next and you see what's the biggest driver, and we have played very well in our portfolios, is the TVS Motors. So, if you go back to 5 years ago, or maybe even 3 years ago until COVID, post-COVID 21 22, most of the existing dominant players in the IC, which is TVS, Hero, and Bajaj, did not have a significant presence in the EV market. The EV market was primarily ruled by companies like of Ola, couple of names that I don't even remember, were a very significant market share until 3 years ago, are nowhere in the plight of the market. In fact, at a point in time, I remember in a remote place like like my native, there were 17 to 18 EV brands which no more exist as we speak in 2025. In a matter of 3 years, the market has actually come down to hardly few players from 25 26 player market. So what I'm trying to say here is TVS not only played the era of getting disrupted because of the significant IC scooter business, but they also created best-in-class scooter called iQube, and we all know they are the largest market share in the country now with a 23% market share. And not only have they delivered exponential growth in that business, but they obviously adapt, and reinvent themselves to take significant, advantage of the new opportunity that is coming our way. Similarly, when you look at the on the right hand side, Ather and Ola volumes obviously have not been as promising as been spoken about. In fact, from a market share point of view, as you can see now, Bajaj and TVS will probably supersede Ola in FY26, and there's limited that we want to talk about the other newcomers, which essentially have limited technology capability, nor do have distribution muscle that the existing strong businesses get you on board. Most importantly, and which is one of the again a fantastic opportunity. Ice make refrigeration is a part of the micro marvel series. They obviously are big beneficiary of the quick commerce phenomena. As I was saying in the beginning, consumer behavior patterns are changing every now and then, and also thanks to convenience and the opportunity that the quick commerce offers, ice make obviously offers a significant important tool of providing deep freezers and freezers to the dark stores, because eventually that's how you will meet the end demand. And this opportunity, as I showed, right, the opportunity for the quick commerce going to go multifold between 8 to 10 times in the next 5 years. I think this ice make will be a big beneficiary of the disruption that is going to come our way. So these are the few examples we want to share and showcase you that amongst the portfolio companies and amongst the companies which have been able to transform or able to sort of keep pace with the ever-changing market are the companies who will not get disrupted. In most of the companies who obviously continue to run the business and they were earlier doing will definitely get disrupted. And essentially our sense and belief is to look at the businesses who can sustain this particular changes. Now, just to before we move to next session, just to highlight two three most important points as an investors one should look at. One should clearly think about the long term opportunity of the business that you are investing in. Second, what are the cash flow that the current business is generating in, because it should not happen that the companies keep reinvesting by the external capital, and sometimes the opportunity looks very attractive, but the unit economics is extremely bad. And third most important point is, the what's the kind of technological adaptations the businesses each, whether it's quick commerce in terms of data structure, the data that they have in terms of suppliers as well as customers, or it's the IC versus EV, or it's the likes of ice make or the LGT. In most cases, what is the most important threat that the company is offering or solving to the consumers is the key most important determinant for the investors to keep in mind and invest in such companies. So with that, I will probably move to next session of the next segment of the session, which is the macro update. First and foremost, saying so, all eyes were what's going to happen between India and US in terms of tariffs. But the good news here is India and UK has managed to cut out an FTA deal which was pending for some time. And obviously, we think it's a fantastic news because not only it cuts down the import duty for the UK in the Indian market, but it also opens up a lot of opportunity from India to the US, to the UK market. So auto, textile, and alcohol are the three most important sectors that will get impacted. India import duty on UK cars obviously will cut down dramatically. In textile, India will obviously have a fair share in terms of exports because now India's sort of duties will be at par with Bangladesh and Pakistan, which have 0% sort of duty, and we obviously have a better edge compared to China. Also, oil, alcohol, in import duty on alcohol will cut down dramatically, which will essentially means more premiumization in the market. And not only it will help us to help average consumers to upgrade, but also give better opportunities and accessibilities for the brand in on the Indian for the Indian consumers. Moving to moving ahead to domestic market, I think so the growth, inflation, and most of the indicators seems to be stable so far. I mean the latest economic indicator being GST collection. If you see the GST has hit an all-time high, with again growing 9 to 9.5% on a YY basis. Thanks to RBI timely intervention, we have already seen two measures of rate cut and also significant liquidity measures, which essentially are keeping the cost of funding under check. Also, there is a probability of further rate cut as we proceed further in the next month, as per our understanding. And despite all of these, we think real GDP growth rates will remain fairly robust at 6.5%, despite whatever happening in the global markets and also what we see in terms of tariff and tantrum that we have heard so far from the US market. Moving ahead, this is an important point we want to cover here because nowadays there are so many sort of questions with regards to what's going to happen in the market. A, when the geopolitical concerns are hitting us in between India and Pakistan. B, what is going to be implication for the Indian and emerging markets given where the US is. And C, what is going to be long-term implication for the tariff that is US going to impose. One good news here is we've looked up upon the history, and history usually, if does not repeat certain times, our belief is the dollar index, and you look at the history, right? We are just look at a few data points. Whenever the dollar weakens across the other markets, the dollar, you will see emerging market significant outperforming compared to other markets. So not only has the history suggested that since 1990s till 2025, that as and when dollar continues to weaken compared to other currencies, emerging markets obviously takes a significantly step ahead in terms of capital allocation as well as the returns for the investors. But also the fact that during recession, past 4 out of 6 times, because we also believe that US could head into recession in CY 25. Emerging markets significantly outperform the US markets. And absolutely, there is no doubt that within the emerging markets, India stands absolutely tall and will be the key driver in terms of new capital attraction as well as the preferred choice for investments. So we think this going forward. So calendar year 25 until now, if you see emerging market is obviously up 5% and the dollar index is down 10%. So this is again history repeating, and we think the calendar 25 and 26 will be no different, and this will be a great sort of opportunity for Indian for India market to move forward. Moving ahead, when we look at what's happening on in terms of ownership, for the first time, domestic ownership has overtaken FI. Now, domestic as a when I say domestic, it's primarily DIs, all institutional investors. Cumulatively, our owners have overtaken FI in terms of ownership as in March 25. So this is a historic moment in the Indian capital market history, because if you go back to a decade or even 15 years ago, out of Nifty 500 companies, 21-22% used to be owned by FI, and the domestic ownership would be hardly in 10-11 percentage points. Now we obviously the coin has flipped on the other side, which is again a great sort of news, because now external factors impacting the markets, significant flows and outflows impacting the markets, any significant issues from a global point of view will not have meaningful implications, is what our understanding is, subject to obviously domestic flow sustaining, because we think that needs to be on a regular basis. Otherwise, this will be very tough to sort of continue. But this is a very important development that we have seen after many years. Moving ahead, when I said that it's a dollar weakening is a great sign for emerging markets. FI continues to sort of, despite the sell-off, owns a sizable 18% to the in the NSE 500, and despite the noise that we see, globally as well as in the India, in the relatively emerging market era, India stands very tall in terms of the. We just look at the last 5 years, because on a month-on-month basis, week-on-week basis, the flows, doesn't give you the right picture. When you look at a 5-year period post-COVID, what has happened? Cumulatively, India has managed to get a $15 billion of flows, which is, I think, so absolutely out. No, so nobody comes even closer. Brazil, as a market which is completely commoditized and focused and dependent on commodities, has got a $10 billion of flows. Most of the market, whether it's Malaysia, Philippines, South Korea, Thailand, Vietnam, or Taiwan, has seen an outflow between 10 to 20 billion dollars. So essentially, the message we're trying to showcase here is, although on a weekly, monthly basis, FI monies will keep coming in, coming out, but over a longer period of time, I think so attractiveness of the Indian markets, growth opportunity, as well as the balance sheet size of the companies that we obviously invest with, seems to be a fair reason why the capital will continue to flow in the country. Moving ahead from flows to where are we in terms of earning growth? Earning growth continues to remain a little tepid. If you look at from Nifty point of view, last quarter we delivered 8% earning growth from Nifty point of view, but this quarter we think the numbers could be in the range of low single, mid to high single digit. In fact, Nifty will probably report the full year, between 2 to 3% earning growth, after a very strong 21% earning growth in FY24. Importantly, the things to note out here is, moving forward also, the growth will not be very strong, primarily because of the higher base on the last year basis, and importantly, as we move forward to FY20 Q1 FY26, in a lot of these sectors, particularly export oriented, you will see some moderation in the growth rates. Having said that, from an FY26-27 2-year point of view, Nifty earning growth will be double digit, is what our sense is. And from a valuation point of view, if you look at Nifty, continues to be in the long term average on 20 and a half times. Our mid and small cap names also, if you look at from a broader point of view, are trading at marginal premium between 8 to 12% from a longer term point of view. But that is in context of the kind of improvement in capital efficiency. We have seen a significant improvement in balance sheet and capital efficiency over the last 3 and 5 years, which is why, in our understanding, most of these premium will sustain, and pockets of growth wherever limited will be in FY6 will be the year where you will see a complete bottom of market from earnings as well as return performance point of view.